So, share your secret with us.
Well, our strategy has been to invest in great companies, but over time I've come to refine and understand better what that means. And a lot of, but that's just point one, find the great companies. Point two is being concentrated. There's George Soros said once, it doesn't matter if you're right or wrong, all that matters is how big you are, your position size when you're right and your position size when you're wrong. Yeah, if I'm right on a 1% position, it kind of doesn't make any difference. So we'll take positions of 10 to 15%, in the past even 25% of the fund. And that's a double-edged sword. If you're right, it's fantastic. If you're wrong, it's very painful. So concentration is an important facet, because there aren't hundreds of great ideas and companies, and you might say, that sounds risky. Then it is, and I would look at and ask you, well, how do you define risk? And the best definition of that was, for me, given by Warren Buffett, who we all love, and he defined risk as not knowing what you're doing. Now, there are a lot of investors, and then the third component, I would say, is long-termism. Mm-hmm. Yeah, you can find a great company, but if your time horizon is, very short, you're at the vagaries of what Keynes called the voting machine. He said in the short term the market is a voting machine, and only in the long term is it a weighing machine. And going back to Warren Buffett, he was asked, was Coca-Cola a risky investment when you first made it? And he said, depend on the time horizon. Over 1 year, 1 month, very risky. Mm-hmm. He couldn't tell where the price would trade at. It doesn't necessarily reflect fundamentals in any short or even medium term. And so I do think time horizon is a critical thing, and even intelligent investors are unable or unwilling to have a long-term horizon. And I would put engagement as another component of that for us, of adding value. So those, and so so find the great companies, focused or concentrated portfolio, long-termism, and engagement. Act as an owner, in simple terms. Mm-hmm. But a lot of investors get confused that the thing that you want is growth. Yeah. And if you look at industries like airlines, they've been growing for 100 years, maybe 5% a year, fantastic growth, but collectively and cumulatively, the industry never made any money because competition was too strong. And so growth, per se, growth by itself is not a guarantee of making money. So you need critically barriers to entry to competition, mm-hmm. and sustainable value add and high value add, so that so it's actually a combination of barriers to entry and high value added that you can charge for, and of course then growth has a value. So everybody would agree with those statements, but the interesting thing is, going back again, third time to Warren Buffett, he said most moats aren't worth a damn. Mm-hmm. Because you think you've got a moat, and then it erodes. Mm-hmm. And so the real thing is sustainability of moats. you know,
So how do you find out whether a great company remains a great company over time?
Yeah. Well, one of the things is to understand the, the forces of competition and substitution and disruption are very powerful. And we've learned, just as in the same way people underestimate complexity structurally, most investors underestimate the forces of competition and disruption. Why? Because they're short term. It keeps going back to the same root causes. And so we learn through examples and through sometimes experience and suffering. One of my investments 30 years ago, before I started TCI, was with a European media company that Bain Capital had bought control of, and it was a monopoly, and they bought it control. It was like €1 billion valuation, and the stock went to a 50 billion valuation, from 1 billion to 50 billion, and then it went to zero. And it was a Yellow Pages company in Italy, because the internet hadn't been found. People thought it was a resilient monopoly, but Google destroyed the company. So we sometimes don't know. Yeah, we can't know what hasn't been invented. So then, how can you know anything? You might say. Yeah, it was Cheney who said, "Yeah, unknown unknowns." So, you don't know what you don't know. But But certain industries are more prone to disruption than others. Your risk is much higher, and so we try to avoid those sectors because you're asking for trouble, or limit our exposure. And one of those sectors is technology.
Yeah. So what are the ones you like?
I've always liked, as one example, infrastructure, where which is a bit unusual, it's not that sexy, it's a bit boring, owning toll roads and airports and transmission lines, cell phone towers, but I was born into a poor family, and so I always wanted to get my capital back. I thought that was a good starting point. Don't lose your capital. And so I sort of believed in physical asset backing, which most investors don't look at tangible book value. That's something, forgotten in economic textbooks as a metric, or a placement value. But an example is maybe 9 years ago, the Spanish government approached us and about taking an anchor position in an IPO of their airport, Aena. And airport was basically brand new, huge under capacity, and 75% of the value was in unregulated shops and car parks, and complete monopoly, unregulated, and huge growth potential. And they sold it at a 15% free cash flow yield. And what we could see is that you could never replace these assets, Madrid Airport and Barcelona Airport, and irreplaceable. And they sold it at the right price. Valuation matters. They sold it at a 15% free cash flow yield.
So I learned at school that a great company is not necessarily a great investment. But you look at something like cash flow yield to tell you now it's a good time to buy.
And sometimes people say things are cheap for a reason. Now, people were concerned about government ownership in this case, regulation, and the government did impact it. They limited the compensation of the CEO to €200,000. And ultimately the CEO left. He was a very good CEO, the original And so, but it didn't matter because the monopoly was there, the assets were there. So I like asset backing of infrastructure. Another sector that we've...
Can I just
Yes.
ask you one question on this? If you like an asset, the physical asset, does management quality matter? Is it important?
Less so. It matters for reinvestment risk. But one of the things I mentioned that we do is we act as owners. Yeah, people have different terms for that, constructivists and activists, but I really think fundamentally it's acting as an owner. And in the case of, we were worried we didn't have any control, but we had influence. I was asked to be on the board. I was on the board for 3 years of Hohn, the airport company, and we went to the government and to the board and said, look, you're throwing out all this cash flow, billions of euros of cash. You don't need it. We want to propose an 80% dividend payout ratio. And for you, that's dividends you can spend, and they agreed to it. And so my reinvestment risk of management was limited then, very limited. And so there are things you can do to mitigate risk. But it does matter, another infrastructure asset we've been invested in is in the toll road sector in Ferrovial, where there's a family that have about a quarter of the stake, and they're fantastic capital allocators. They just reinvest. They sold Heathrow Airport recently, at a low return, and they're reinvesting in monopoly toll roads at high returns, and they just really know their business and have high alignment of interest. So, but again, Buffett said you've got to. Ideally, you should invest in an industry where a monkey could run it, because one day they will. And so, I want to find an asset where, because there's no guarantee the CEO comes back.
Yeah.
Yep. And so, I think you have to invest in a business where it's a great business and it doesn't depend on the manager, because there's no, the assets are ultimately more reliable than the manager. So, but so in this sort of where are the moats? We talked about infrastructure and physical, non-replicable assets. Another space we like, as an example, is aerospace. Things like aircraft engines and manufacturers like GE Aerospace and Safran. And we like that space because the barriers to entry are extremely high in terms of intellectual property. It's so complicated to make this product that there have been no new entrants for 50 years.
Yeah.
So new entrants is a sign of the barriers to entry. It's one of the criteria you can look at. And why is that? Not only is it very complicated, you make the money in the spare parts. So once you've got this installed base, the new engines are only a small percentage, and the airframers only want 1 or 2 engines. It's too complicated otherwise. There isn't the room for multiple competitors. And then for various reasons, it's very difficult for competitors to enter the replacement parts. And so the switching costs, so that's another space where very intellectual property can be a barrier.
You mentioned long-term themes. This approach that Christian takes on investing in long-term structural themes, something that resonates with you?
Yeah. The average life of holding of our current portfolio is 8 years. Now, the average holding of a US stock is less than 1 year. So investors are absolutely en masse short-term, trading-oriented. And so why, you know, but we should ask, well, why is long-termism? Is it a good strategy? Yeah. Is it why? And why?
I'd like to think it is.
Yeah. In this
Well,
house.
we should ask the question why. I always say justify. Yeah. And if you look empirically, it turns out that the very best companies, high ROEs, they stay good. They don't disappear overnight generally. Yep. And bad companies stay bad. Low ROEs stay low ROEs.
I totally agree. We have an expression: good companies are better than they seem. Bad companies are worse than they seem.
There's
So
persistence.
it's better. You got to get rid of the bad ones and just double down on the good ones.
Yeah, there's persistency. And the value of that company is only seen over the long term. So they say there's no free lunch in finance, but actually, I do think long-termism in a great company is a free lunch, because if you look at any sell-side model, they'll go out 3 years, or 2 years. And that's why? Because that's the time horizon of the typical buy-side investor, 1 or 2 years. But what if it can keep being good for 30 years? Then you're completely undervaluing that company. And people don't look at it because there are most companies, 95% are mediocre or bad companies. Yeah, and they meet their cost of capital, but they're not super companies. One of the companies I mentioned, aerospace, we invested in Safran. We've owned it for 13 years now. And we're actually one of the largest investors in the company, and we made around more than a 20% IRR for 13 years. It's a long period. That duration.
Very long.
Yeah, very long period.
What company was that?
Safran. Yeah, they were a joint venture with GE Aerospace in aircraft engines, and so we have investors who would come in and say, well, we want new things.
Yeah. Why is it so hard for investors to be long-term? I understand there are commercial pressures, but there must be more.
They think new is better. I say, do you change
your volatility?
Yeah.
What can you do in the public market as an activist? And your approach has evolved a little bit over time.
Yeah, it's an interesting debate, private versus public. Because I do think the very best companies in the world are public companies. Not everyone, but generally. And one of the reasons is in many industries, scale and scope matter. Small is not beautiful. An example of this is video conferencing, where Zoom, new innovator, brought out video conferencing, and Microsoft launched Teams and just distributed it free, integrated in their bundled Office product. Now, people say Zoom was a better product, but Microsoft won because they had this bundling strategy and they had scope. They had advantages of scope and the ability, customer relationships, and so I think people underestimate sometimes these powers of big companies of incumbency to crush a competitor, so a public market investor doesn't have no influence. Okay, if they're willing, they can influence, and sometimes stopping stupid things. And an example of Safran, we had this great company, reported 8 times earnings, it was compounding at 20%, and then one day they came out and tried to make an incredibly stupid acquisition of a company called Zodiac, a wild overvaluation using shares which were half their intrinsic value. So it was doubly bad. And we fought the deal, and in the end, they cut the price in half and then paid only in cash. And the share price doubled. We got sued by the seller. I was sued personally for 100 million euros, and my CFO came to me very stressed one night saying, it's all right for you, you can afford it, but they're going to bankrupt me. And because the seller lost €1 billion, but few investors will act like that. Yeah, most just accept it. But in the end, they cut the price and blamed us, which was fine, and all's well that ends well. They never did silly things again.
But then you have to, if I may jump in, you have to have a big enough ownership stake to actually have that influence, don't you, in some form? Or at least a real voice that they will listen to. And the challenge in the public markets, if I may challenge that, is that often the companies become run by the management, right? Because they're ultimately the ones then, with no active shareholders, they effectively point the board, and you have a bit of a
that can happen.
That's the other side of the coin. Yeah?
It's a big risk, and in general, maybe the general is, there are many companies with bad governance that become badly run. Yeah. And I'm not a believer in being an activist in a bad industry or a bad company. That doesn't make any sense. But there is I don't actually think the shareholding necessarily is everything. Can matter. We went recently on the board of a company called Cellnex, cell phone towers, and we had 10%. And so it mattered because there were four shareholders with 10% each, and so it was very concentrated. But I think the power of the argument can win. Shareholders are not stupid. Norges Bank is not going to be an activist themselves, but if an activist makes a good case, they'll support them.
Yeah, they'll listen.
Yeah, they'll support them. Whatever stake the activist has, 1%, 2%, it doesn't matter. So,
And can we go back?
Like everything, there's pros and cons, arguments for and against. But in private equity, you pay a price for control. You pay a premium. Yeah, can be big. So. Don't get me wrong, control has a high value. Has a value, let's say. It has a value, but is it worth 40%, or whatever premium you have to pay in a competitive auction? In public markets, there's an offer every day. Yep, you can take it or leave it, and so it's. I think so I just think that point is relevant. Entry price matters.
Do you think liquidity is overvalued in the markets?
Well, the thing is,
why do people need liquidity as much as they think they do all the time?
You can be wrong. That's something I learned. The Yellow Pages example was. And if you're if you're wrong in private, there's no way out, in a short term. And if you're wrong in a public, you have a chance to get out, You have a chance.
But you don't really have a chance to repair and improve, which you do in private. Right?
To the extent
we can huddle down, change the management, change the board, divest underperforming operations. So it's just a completely different mindset.
To a point, there's we were investors in cable, in the US, and
we own a lot of cable.
Charter and Communications, and before that Time Warner Cable, and it was a great investment for 8 years. We made 5 billion of P&L and 5 times our money. But then the industry started to deteriorate. It became saturated and more competitive, and people started overbuilding private equity.
Yep, we bought lots of those companies.
Yeah, so it started overbuilding.
One of our best sectors, actually.
And I sold, because it changed.
We were buying.
Yeah.
Yeah. Unfortunately, we are at the end of the session already.
That's too bad.
I would love to continue for much longer.
I learned a lot.
Chris, you shared many of your secrets. You shared more in a podcast that you recorded with Nikolai, which will be released on the 14th of May. So I encourage everyone to listen to that one. We'll take a break now. So please be back in this room at 15:25. But first, and most importantly, a big, big thanks to both of you for sharing your insights and wisdom.
Good to meet you. It was fun.